Thank you all for being here. Thank you, Chair Powell, for joining us today for such an important conversation. Before we begin, I do want to take a second and thank you, Jay, for following through on your commitment to remove reputational risk from bank examination at the Fed. This is a necessary first step toward ending the politicization of bank supervision, and it is certainly a step, in my opinion, in the right direction. But it's not enough to change the policy on paper. Examiners need to implement it in practice, and I hope they do. I will say I was actually a little surprised when we were talking on Monday that you didn't bring it up during that conversation, since it happened a few minutes later, but it was good to see nonetheless. The Fed plays a central role in the health of our economy and the stability of our financial system. But with that role comes responsibility to be accountable to the American people, to remain independent from political pressures, and to be transparent. Unfortunately, over the past few years, many Americans have lost confidence in the Federal Reserve. Since 2021, American families have endured persistent inflation, rising interest rates, and a tightening squeeze on their wallets. A college student trying to cover tuition and food with a part-time job is finding that everything costs so much more, while credit costs have doubled. A senior citizen trying to downsize is watching mortgage rates skyrocket and fixed incomes fall behind. Yet during this time of hardship, the Fed has spent billions on lavish renovations to its DC offices. We're talking about rooftop terraces, custom elevators that open into VIP dining rooms, white marble finishes, and even a private art collection. All this costing $2.5 billion, a 32% increase from the original $1.9 billion price tag at a time when the Fed hasn't turned a profit since 2022. We can all agree that updating aging infrastructure is a legitimate need. But when senior citizens can barely afford Formica countertops, it sends the wrong message to spend public money on luxury upgrades that feel more like they belong in the Palace of Versailles than a public institution. At the same time, the Fed's role as an independent, apolitical institution is being questioned. The central bank joined a global organization to green the financial system under the leadership of President Biden, and only to exit it as soon as President Trump took office. That's not neutrality, that's drifting. Now let's turn to supervision at the Fed, which at times is unduly burdensome. The Fed must right-size the regulatory framework for banks to eliminate unnecessary burdens, especially community banks. I'm encouraged that the Fed is taking important first steps on capital, and I look forward to seeing what comes from the board's meetings today on revisions to supplementary leverage ratio standards. But more work needs to be done to ensure capital rules don't choke off access to credit for entrepreneurs and working families. That's why I want to underscore the importance of empowering the newly confirmed Vice Chair of Supervision, Governor Michelle Bowman. Governor Bowman has been a consistent voice for transparency, accountability, and just plain old-fashioned sanity. I expect her to lead on reform at the Fed, and I expect you as chairman to afford her the same stature as her predecessors. I look forward to hearing from you and your testimony. Ranking Member Warren, you are now recognized.
Thank you very much, Mr. Chairman. When he ran for president, Donald Trump repeatedly promised to lower costs on day one. Those were his words. But since Trump became president, families have been more financially stressed than ever. Since January, consumer sentiment has plummeted. Since January, household debt and delinquencies continue to climb. Since January, workers' worries over layoffs have climbed. Since January, businesses big and small have been paralyzed by uncertainty, and they have hit the brakes on investments and hiring. The cause of these problems has been the chaos caused by one person, President Trump. Chaotic trade policies, massive cuts to families' health care coverage to fund tax giveaways to the wealthy, and wholesale deregulation of our financial system that will unleash fraudsters and con men on the middle class. First, trade. Trump continues to play his lose-lose game of red light, green light on tariffs. When this administration slaps tariffs on everything from food to clothing to electronics, working families pay the price. This is bad for the middle class and bad for Main Street. Tariffs like these mean higher prices on essentials for consumers and small businesses, while large corporations and the wealthy find ways to shield themselves from the impact. Second, tax cuts for the wealthy. Trump's one big, beautiful bill that Republicans are jamming through Congress represents one of the largest transfers of wealth from working people to millionaires and billionaires in American history. How are Trump and Republicans paying for part of this $4 trillion in tax giveaways to billionaires? Well, by kicking 16 million people off their health care coverage, cutting food assistance for more than 2 million children, and raising monthly student loan payments for millions of borrowers just after delinquencies have skyrocketed. In addition to raising costs for lower and middle class Americans and taking money right out of their pockets, this bill will also choke economic growth. This isn't tax policy, it's economic warfare against the American people. And even when they throw 16 million people off their health care, the Republicans still can't pay for the lavish tax giveaways to billionaires. So instead of just saying that billionaires and billionaire corporations should just pay a little more in taxes, they put the costs of those billionaire tax cuts on the nation's credit card, the national debt. The Republicans plan to run up the national debt by another $4.2 trillion and expect our children and our grandchildren to pay for it. And finally, deregulation. This administration is systematically dismantling the safeguards that policymakers put in place after the 2008 financial crash to prevent Wall Street from creating another crisis. Less than 2 weeks ago, the Fed board decided to lift Wells Fargo's asset cap. You couldn't even wait until Wells managed to make it one whole year without being caught in a major financial scandal. In just the past 6 months, Wells has been caught and confessed to cheating its customers, cheating its investors, and cheating its workers, the trifecta. For the Fed to give them a gold star and tell Wells it's okay to expand the number of customers, investors, and employees that it can cheat is an outrageous giveaway to one of Wall Street's most derelict banks. And today, you will leave this hearing and go directly to a meeting where the Fed is expected to vote to lower capital requirements for JP Morgan, Goldman Sachs, and the other too big to fail banks. At a time when the economic data are flashing red, these short-sighted changes will increase the likelihood that these mega banks once again tank the economy and then come back here to beg Congress for bailouts when their risky bets go bust. To sum up Trump's economic agenda, it's chaos and pain for the middle class and even more profits for the powerful. American families will face higher costs and new risks to their health care and their bank accounts. Unemployment will tick up and our economic growth will slow. And that's not just me saying this, it is exactly what the Fed's latest economic projections indicate. I hope my Republican colleagues will wake up to the chaos around us. It falls to Congress to stop Trump's trade war and kill this big, ugly bill. And Chair Powell, it falls to you and the Fed board not to pile additional risk onto Trump's existing chaos by dismantling the safeguards that protect American families from another Wall Street meltdown. Thank you, Mr. Chairman.
Thank you, Senator Warren. Today we'll hear from the Chair of the Federal Reserve, Jerome Powell, on the Semiannual Monetary Policy Report to Congress. Chair Powell, thank you for your testimony today, and you have 5 minutes.
Thank you. Chairman Scott, Ranking Member Warren, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's Semiannual Monetary Policy Report. The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective, and we are attentive to the risks to both sides of our dual mandate. I will review the current economic situation before turning to monetary policy. Incoming data suggests that the economy remains solid. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged a moderate 124,000 per month in the first 5 months of the year. The unemployment rate at 4.2% in May remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE in prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. With the labor market at or near maximum employment and inflation remaining somewhat elevated, the Federal Open Market Committee has maintained the target range for the federal funds rate at 4.25% to 4.5% since the beginning of the year. We have also continued to reduce our holdings of Treasury and agency mortgage-backed securities, and beginning in April, further slowed the pace of this decline to facilitate a smooth transition to ample reserve balances. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Policy changes continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. The FOMC's obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Now, I'll be keeping us to a pretty strict 5 minutes, as we have a lot of senators who want to and deserve time with the chair of the Fed. So, Senator Rounds, we'll start with you.
Thank you, Mr. Chairman, for the courtesy. Chairman Powell, first of all, let me just touch base on, I'm just curious, a couple of items almost of housekeeping nature. With regard to Wells Fargo, was that asset cap and removing it, that was a unanimous vote by all 7 Fed governors, as I recall?
Yes, it was.
Okay, thank you. I really appreciated the chairman bringing up the fact that you have identified reputational risk and have addressed it. I think that was a really important item for the Fed to do, following up on both the OCC and the FDIC's actions. As you know, past Fed materials like the supervision and regulation report often embedded reputational risk within the management component of the CAMELS rating system without clear metrics or accountability. That kind of ambiguity can chill lawful activity and distract from your core mission, monitoring capital, liquidity, and operational resilience. Now that the Fed is moving toward a more objective and disciplined approach to supervision, how will you make sure that this change is fully implemented at the examiner level? And more broadly, what other regulatory updates can we expect?
So on following through on supervision, Vice Chair for Supervision Bowman actually brings an unusual background to this work, and that is that she's a former supervisor. So she speaks that language and relates to their work. And I think if anyone can have an effective relationship with them and work with them successfully, it would be Vice Chair for Supervision Bowman. So I'm confident about that. As we think about things that are going on in the pipeline, so I would just point to a few things. Basel III Endgame. We're going to look at the rating system. We're going to be actually voting to put out for comment something on supplemental leverage ratio this afternoon. We're looking at our merger policy. Stress tests is a big thing, and there are a number of things that we're looking at that we've announced and we'll be moving to in time.
Thank you, sir. The payment of interest on reserves has become a central pillar of the Fed's post-crisis monetary policy framework. Since the transition away from the pre-2008 scarcity model, where reserves were tightly managed to influence the federal funds rate, the Fed has relied on an ample reserves regime using administered rates like interest on reserves to maintain control over the short-term rates. As of February 2025, nearly 19% of the $18 trillion in bank assets were effectively loans to the Federal Reserve earning interest. Given this structural shift, how feasible would it be for the Fed to return to a scarcity-based framework where reserves earn little or no interest? And if interest on reserves were eliminated, what would be the impact that would have on the Fed's ability to unwind its balance sheet and manage policy rates?
So we're in an ample reserve framework now, and that's a good thing. That's a result of the global financial crisis and the desire to have lots and lots of liquidity and large liquidity requirements for our largest banks in particular. So that's a good thing, and that enables banks to keep lending through stress and that kind of thing. If you were to want to go back to a scarce reserves, it would be a long and bumpy and volatile road. I wouldn't recommend that we undertake that road. It would not save any money. There's an illusion that it would save money. That is not the case. And it would also not make credit more available. This, in effect, I would say having a lot of liquidity in the system, which is what goes with ample reserves, make sure that banks will be able to continue to lend. So we think it works, and I think unwinding it is a policy choice which could be executed, but it would take years to execute, and it would be challenging and quite volatile.
Thank you. I've just got about 35 seconds left or so, but I did want to touch on one item. That the chairman mentioned it, and I think it's important. I know that you didn't mention it in your opening statement, but Would you talk a little bit about just exactly what's going on with your building? When you have that type of an overrun on the prices and you're talking about billions of dollars in costs, I think it's appropriate for you to be able to explain to the committee exactly what's going on. Would you take a few minutes, please, and explain what's going on with the value of that building and why the costs seem to be so exorbitant?
I'd be glad to if I can have that time. So
Please.
thank you for the letter we received late yesterday. We will provide a much more detailed response, but just generally, I would just say we do take seriously our responsibility as stewards of the public's money. And the other thing I would start with is no one in office wants to do a major renovation of a historic building during their term in office. You much prefer to leave that to your successors. And this is a great example why, let alone two historic buildings that needed a lot of work. But we decided to take it on because, honestly, when I was the administrative governor before I became chair, I came to understand how badly the Eccles building really needed a serious renovation. It never had one. It was not really safe, and it was not waterproof and that kind of thing. So we took it on. I would also say that the media reports that you accurately quoted, they're misleading and inaccurate in many, many respects. And I would just point to, there's no VPI dining room. There's no new marble. We took down the old marble. We're putting it back up. We'll have to use new marble where some of the old marble broke, but there's no new, there are no special elevators. They're old elevators that have been there. There are no new water features. There's no beehives, and there's no roof terrace gardens. Other than that, so all of the sort of inflammatory things that the media carried are either not in the current plan or just inaccurate. So, but notwithstanding that, the cost overruns are what they are. So let me just say on that.
Well, we're well over the 5-minute mark. I'm happy to give you time to talk about that. I'm happy that there are no beehives in there, but we're going to figure out what they are anyways. Senator Warren.
Thank you, Mr.
Thank you,
Chairman.
Mr. Chairman.
Thank you. So, Chair Powell, the Fed released its updated economic projections last week, and I appreciate your summary, but I want to look at the trend lines here. The Fed's outlook on inflation, the labor market, and GDP growth have all gotten worse. Compared to your economic projections in December, the latest numbers show that the Fed is now projecting higher inflation, from 2.5% in December now to 3.1%. Higher unemployment from 4.3% to 4.5%. Lower economic growth from 2.1% projected just 6 months ago to 1.4% that you're now projecting. Chair Powell, what has changed in the last 6 months that has caused the Fed to forecast substantially higher inflation, somewhat higher unemployment, and lower economic growth than you did in December?
So some of it is just taking signal from data reports that we've seen. Some of it is people working in the possible effects in the short term of tariffs. We have no view on the wisdom or the longer term effects of trade policy. It's not our job. And by the way, I should add, our forecasts are generally, and in this case, are very, very similar to what outside forecasters
I
are
understand
calling
that.
for.
I'm just using you as the gold standard here. I know it's consistent. But you mentioned tariffs as one of the things that has changed over the last 6 months. Donald Trump has become president and the economy has headed down. Not only does the Fed data now show slower growth and higher prices this year, it sees slower growth and higher prices over the next 2 years as well. And the Fed sees no longer-term boost to the economy or drop in inflation. In other words, no upside to Trump's chaotic tariff war or his other economic policies. So let's talk for just a minute about what's under the hood of the Fed's economic forecast. Chair Powell, I know a lot of different factors influence the trajectory of interest rates. Is one of those factors how quickly the federal debt grows relative to the growth in the economy?
Not directly, no. We don't look at that as a factor that helps us set monetary policy.
So you're not watching the ratio between the amount of the federal debt and the growth in the economy?
No.
How fast the debt is growing and how fast the economy is growing? I think I have quotes from you saying last year, quote, "We don't need to pay the debt down. We don't need to balance the budget. We just need the economy to grow faster than the debt. Are you saying something different from that now?
No, when asked and pressed, I pretty much always say the same thing as my predecessors, which is that we're on an unsustainable path. I would not say, though, that we do, I will say this, we do not look at federal financial policy and deficits as something that affects our month-to-month monetary policy decisions.
I'm trying to get the overall projection of what happens in the economy. So, for example, I think you have made the point that if we spend on things like childcare that can boost labor participation and GDP, that may be a time when you offset the debt that you incur to do that. But if there aren't investments like that and we are simply running up the debt, what's the impact of increasing the national debt? So I understand that you don't comment on fiscal policy, but it does affect your job, which is keeping inflation under control and also maximizing employment. If certain policies would materially drive up the national debt and increase the debt to GDP ratio over time, could that make it more likely that we would see inflation, all else being equal?
I mean, theoretically, sure, fiscal policy can add to inflation, but that's, again, that's really not something we comment on. We try to stay away from fiscal policy.
I understand you don't comment on it, but I do appreciate your acknowledgement of the math here. You know, the Joint Committee on Taxation projects the one big, beautiful bill would increase federal deficits by $4.2 trillion. According to analysis by the Congressional Budget Office and the Yale Budget Lab, the bill raises the debt to GDP by 24 percentage points. It slows economic growth, it increases inflation, and it reduces real wages. So two of Trump's signature policies, his tariffs and his tax bill, will increase costs for American families. When America borrows money, it should be for investments that Americans need, like investments in childcare or housing or healthcare that would actually boost economic growth and lower costs. America should not take away healthcare from millions of people who need it and then borrow trillions of dollars just so that a handful of billionaires and giant corporations can get even richer. Thank you, Mr. Chairman.
Yes, ma'am. Chair, banks are facing a record number of regulations. Small community banks are especially burdened by compliance costs. Bank capital requirements should also be appropriately calibrated so banks are not forced to park capital on the sidelines, limiting access to capital for Americans and small businesses. I was pleased to see that the Fed is looking to reform the supplementary leverage ratio. The SLR is supposed to act as a backstop to risk-based capital requirements, but too often the SLR acts as a binding requirement for U.S. banks. Would you agree that adjusting the SLR would free up capital for banks to invest more in treasury markets and other low-risk assets that would be beneficial to families and businesses across the country?
I would agree, yes.
Do you agree with so Vice Chair Supervision Bowman recently acknowledged that regulators tend to review individual elements of the capital framework in isolation without considering whether proposed changes are sensible in the aggregate and contribute to a capital framework in which all components work together effectively? Do you agree with her assessment, and how are you looking at the capital framework holistically to ensure that the Fed is not stifling economic growth?
Well, we're looking at basically the two big pieces now are Basel III and the leverage ratio. And I'm pretty confident we'll move on both of those in the relatively near future. And they fit together, as we discussed. The leverage ratio was always supposed to be a backstop rather than the binding. We want risk-based capital to be the binding capital requirement. So that's how those two pieces work together.
And as you look at I hope a reintroduction of Basel III, if you're thinking about the bones of Basel III, obviously, over the last several years, we talked about this on Monday, we've heard the comment that the capital requirement was about right, although that capital requirement has been going up every year. And so as you look at Basel III coming back and hopefully being reintroduced and not just recalibrated, what do you forecast?
Well, we very much look forward to working with our colleagues at the OCC and the FDIC on Basel III Endgame, and I would agree we're gonna take a fresh start at that. You know, the last proposal was actually well above Basel minimums. That's the thing. It was the ways in which it was gold plated, as we say, rather than the Basel requirements, which were very significantly exceeded.
Just giving us an opportunity to go back to the spending at the Fed for the construction, and you said that the items that were listed are not happening. I will say that the National Capital Planning Commission website, ncpc.gov, anyone can take a look at it for themselves, not just looking or listening to the New York Post, not just the Wall Street Journal, but page 129 of the final plans reflected rooftop garden terraces. The page 127 and 129 were where we found the ornate water features and final plans. The new elevators that dropped board members off at the VIP dining suite was page 37 of the final plans. The white marble was pages 40, 41, 65 of the final plans. I would welcome your staff coming in to walk my staff through what is happening there, as opposed to what we not have only read in the New York Post, not only in the Wall Street Journal, but also at the National Capital Planning Commission's website. So we would welcome that opportunity to have a
Can I just
thorough
quickly
meeting. Certainly.
say, some of those are just flatly misleading. The
Sure.
idea of elevators, you know, it's the same elevator. It's been there since the building was built. So that's a mischaracterization. And some of those are no longer in the plans. They've, you know, that's earlier. The plans have continued to evolve.
That was one of the questions I asked my staff before having the conversation with you in preparation, and assuming that your response would be to refute some of the things that were happening, was to ask the question, well, since the articles came out in April, have the plans changed since April as a result of the media attention to it, or was that just never in the plan? I would just say that having an understanding, a clear understanding of what's going to be and when it changed would be helpful for us. I will note that having confidence in what we hear is incredibly important, and I would give you the opportunity to bring your team in and or send your team over so that we can have that conversation. That would be helpful.
Look forward to doing that. And if you'll allow me to say one more sentence, none of those things were the cost drivers. You know, the real thing is what were the cost drivers that caused the spending to increase, and we have those too, but those are not the things that did that.
Well, I don't want
We
to
look forward to the conversation.
I don't want to eat into Bernie Moreno's time because he's kind of cranky when I do. I would just suggest that when I hear that things are completely and wholly inaccurate, and then I hear that they weren't quite the way they were, those are two very different framings of the conversation. And I only read page 129, 127 through 129, page 37, page 40, 41, page 65, page 129, because I could be wrong without any question, but I don't want to be misled. That's different. Next would be Senator Reed.
Thank you very much, Mr. Chairman, and thank you, Chairman Powell. Many times you've been asked about the status of Fed independence from the president, his constant harangues about interest rate policy, et cetera. But over the past year, we've also seen judicial pressure on the Federal Reserve's independence. The Chevron case, which dramatically eliminated the deference to agency decision-making, also extended the statute of limitations on the Administrative Procedure Act. And there is a strong sense that they're about to overturn Humphrey's executor case, which will eliminate the independence of practically all agencies. What's your judgment on the cumulative effect of these judicial actions with respect to the Federal Reserve's ability to do its job?
I mean, the net effect of all of those will be to make courts substantially less deferential to agency decisions. And so that's just the new world we live in. We'll continue to do our jobs, and obviously we'll respect the law as it is. That is the way the law has been evolving, though.
But there is increasing pressure on the independence from the White House, and Do you believe that if Humphrey's executor's case is decided in a way that gives the White House more additional authority, that'll be invoked against the Federal Reserve?
I'd rather not speculate, if I may, Senator.
That's quite all right. The U.S. dollar. I remember when the phrase was "sound as a dollar." That phrase is getting less used these days. In fact, Bloomberg reported last week that foreign companies are demanding to be paid not in U.S. dollars, but in euros or Chinese renminbi. First, what benefits does a strong dollar have for us, and how will we suffer if the dollar is no longer considered to be the currency of world record?
Right, well, so there are enormous benefits to having the dollar be the most important reserve currency in the world. It remains such, and for very long standing and continuing reasons, which is, our rule of law, our democratic institutions, our commitment to price stability, our open capital markets. All of those things remain intact, and I think being the reserve currency doesn't last forever, but it's quite a durable equilibrium, and I suspect that we will be the world's reserve currency for a long time to come.
But you're seeing indications that confidence in our currency is eroding in some places. Is that those?
I wouldn't say that. I think it's this is a very fundamental kind of foundational aspect of the global financial system, is the role of the dollar. And markets move around. Markets are digesting information that's sometimes very challenging to digest. I'd be very reluctant to come to any longer run conclusions about things that fundamental this quickly.
Well, I would suggest, and I know you'll keep your eye on it going forward. One of the things you've made very clear is that income inequality and lower rates of upward economic mobility are two of our biggest challenges. And you've also indicated that this is probably beyond the ambit of the Fed in terms of dealing with this. These are more legislative issues. And I would concur. So I was disheartened to read a report from the Congressional Budget Office, which is an independent agency, that the recently House-passed reconciliation bill will take approximately $1,600 per year from the lowest income Americans and give approximately $12,000 to the wealthiest Americans. That seems to be directly contradictory to a society who's committed to raising the income and opportunities and increasing upward mobility. Do you think that's a fair estimate?
I don't know, and I'd be very reluctant to comment on the reconciliation bill, even indirectly.
Well, your wisdom and sagacity has preserved you, and I hope it continues to do so. I must commend you finally. By 2 or 3 years ago, everyone around here was predicting or guessing how deep the recession would be. And because of your leadership at the Fed and other policies, we've avoided a recession. In fact, until recently, we've been growing faster than every other economy in the year, and you deserve credit for that. Thank you.
Just to reiterate my opening comments for those who may not have been here when I made the comments that Chair Powell has a hard out today. Therefore, I'm going to do my best to keep us at 5 minutes each. Senator Kennedy.
Thank you, Mr. Chairman. Thank you, Mr. Chairman. Mr. Chairman, did I understand you to say that the reconciliation bill is the most extraordinary legislation you've ever seen? Did I hear that correctly?
There may have been some lost in translation
I
there.
understand. I was a little late. Tell me what tell me what the bond market's telling you.
Bond market's fine now, functioning well. It's pricing, it's reacting to economic news. There's adequate liquidity. Rates have come down pretty significantly from where they were a couple months ago. So I think I think inflation expectations have come down a bit from April, and in general, the bond market is is functioning well.
Okay. Explain to me why we have seen in the last few months weakness in the dollar.
That's a great question. And of course, the Treasury Department has the job is responsible for the role of the dollar. So I don't know. I think I would go back to the thought that markets have been digesting an unusually challenging set of circumstances, and have reacted the way they've reacted. The dollar's kind of stabilized now. In fact, it's moved back up here in the last couple of weeks a bit. And there are plenty of people who are still writing that the dollar is still overvalued. We don't have a view on that, of course, but I wouldn't really have an opinion on exactly why it is where it is.
Well, clearly there's a lot of geopolitical risk right now, which would lead one to conclude, all things being equal, that people would be flocking to the dollar and it would be stronger.
Well, you have seen some of that here in the last few days. But again, I don't really have an official view I'd like to share on that. I think there are possible explanations, multiple possible explanations. Again, one of which is that some people still feel the dollar is highly valued.
Yeah.
But we'll see.
I want to talk for a few minutes about tariffs and inflation. What does history tell us about tariffs and its impact on inflation or deflation?
So the thing is, we've been through a long period in which tariffs were going down. Remember, since World War II, really, it's been a process of lowering tariffs globally. So there just isn't a lot of modern learning on that. I think people look at the incidence of tariffs during the president's first term, but those were like 1/6 the size of what's people are estimating now. And they do find some effects on inflation. But remember, in 2019, when those tariffs were put into place, the economy was slowing. We actually cut rates 3 times. Inflation was running at 1.5%. So it was a very different time. This is different. I think one of the reasons why it's so challenging is that there really isn't a modern precedent. Yeah. And I think we have to be humble about our estimates. And we are very open to the possibility that transmission through into inflation will be less than we think, or maybe more than we think, which is why we're in a position of wanting to take our time and make a smart decision as we see how this unfolds.
Well, obviously, the size of the tariffs makes a difference, does it not?
It does.
And we don't know yet the size of the tariffs.
We don't. And we don't have a view on any of the merits at all. That's not our job. Our job is inflation, as you know, and maximum employment.
Will it also matter, let's assume that there is upward price pressure, would it matter how much businesses decide to pass on versus just eat? Does that make sense?
Yes, that matters. That is what matters. The question is, who's going to pay for the tariffs? Originally, it's the importer, but it gets passed along through the distribution chain to some extent to the consumer. The ultimate question of it is how much of it does show up in inflation. And honestly, it's very hard to predict that in advance. So we're watching to see, what shows up in measured inflation.
If the president's trade negotiators pursue reciprocity, which I define as both sides reducing, in a quid pro quo, reducing tariffs and trade barriers as much as possible. Ideally, in a perfect world, we would end up with 2 sides with 0 tariffs and 0 trade barriers. Would that be inflationary?
No, not at all.
That would cause the economy to roar, wouldn't it?
I think it would be.
Yeah. Okay. Thank you, Mr. Chairman. I appreciate your endorsement, Mr. Chairman, of the reconciliation bill.
Senator Warner.
Thank you, Mr. Chairman. Funny, Senator Kennedy, I didn't interpret his comments that same way. I would also say that, one, thank you, and we echo what Senator Reid said, thank you for your independence and doing the job. End of the day, I think tariffs are a tax, and they're going to hit. They're going to hit, I think, starting next quarter. And again, I think the reciprocity argument, that would be a nice goal. I guess I hope we can then explain to the Australians who are a strong ally of us, who we have a free trade agreement, so we don't have tariffs, who we have a trade surplus with, who I'm hoping we're going to be able to build jointly submarines, why they, with all those things, still got whacked with a 10% tariff. Doesn't seem rational or logical to me. But let me get to, I've been very concerned about some of the Trump administration's, I think, mismanagement of the federal workforce. I can tell you some of the DOGE approach in the national security and intel world. Cuts are having dramatic effects. But today I want to mention something that, frankly, doesn't get a lot of attention, a very small entity, the Bureau of Labor Statistics. U.S. economic data, which has always been independent, it's really been viewed as the gold standard across the globe. And frankly, the BLS data often is the guidepost that investors use regularly. BLS helps us get information about cost of living increases, policy making for you guys. It's used to adjust payments on the roughly $2 trillion in Treasury bonds. The truth is that the BLS data shouldn't be degraded on any basis. Yet, the administration is so dramatically, and I hope my Republican colleagues will hear on this, cut back the staffing at BLS, that the BLS has had to significantly cut back on the collection of critical price and inflation data. Normally, BLS staff, when you don't have all the data collected, will estimate about 10% of the inputs into the CPI. Now, with these cutbacks, they've had to estimate close to 30% of the data. That means faultier data. How can we grapple with this, and what does the undermining and staffing shortages at a BLS mean in terms of your ability at the Fed to do your job?
You know, we can still do our job. I would not want anyone to think that the data have deteriorated to a point where it's difficult for us to understand the economy as well as we can understand it, which is not perfectly. But the direction of travel is concerning. You know, the U.S. has been a leader globally in investing in how to measure the output of a modern economy, which is something that we've led the world in for a long time. And it really helps not just policymakers, but also businesses. If we have accurate information about what's going on in the economy, you're making decisions based on that economy, not just the Fed, not just you, but private companies as well. So I think it's I think it's something we should continue to invest in. And I don't like to see any deterioration in the public data, which has been the gold standard. The BLS, Bureau of Labor Statistics, and others have really been the bedrock that people really do look to as solid data that tell us what's
And these
happening
people
in the economy.
who do collect this input, who do some of this analysis, they are experts. They are not fungible. You fired one and hire another. I mean, there's an expertise here that has been, I think, being undermined. And again, you just look at the fact that if you have to do your estimates, move it from about 10% estimate to a 30% estimate, that is not good for the markets. Let me move to one other topic in my last minute. Stress tests, really important. Those of us who are involved in Dodd-Frank, really important as we try to particularly think about the most significant banks. But there has been concern, I've shared some of this concern, that the stress test process was so opaque that while the regulators may fully have understood, sometimes the very banks being regulated didn't understand fully the criteria. I know you're taking a look at how we can bring more transparency to the process. When do you think we'll see that, and what kind of changes do you think we'll make?
Well, later this year, we've said that we're going to, fully disclose the models, and that's the main thing. If you're going to set, it's like the IRS. If you're going to charge people taxes, you have to have the transparency about what that is. It's going to be the same as that. We're going to show how the calculations are made, and we're working on all that right now. We're also going to, we have a proposal out to sort of smooth the results of the test from year to year. So this is something we're working on hard and expect to have important progress later this year when we begin to publish the models.
I'm anxious to see it. Thank you, Mr. Chairman.
Senator Ricketts. Yes, sir.
Thank you, Mr. Chairman. As we were talking about tariffs a little bit earlier, the senator from Virginia talked about Australia. I will point out that Australia has, well, we bought about $28 billion worth of Australian beef, and they've bought exactly zero of ours. So there's an opportunity to be able to improve that trade relationship. So that's one of the things I hope will come out of the trade negotiations.
You will acknowledge there is, though, we actually have a trade
We actually have a
surplus.
trade surplus with Australia, that is correct, but we'd like to sell more beef to them. So that's an opportunity. But one quick question on that, kind of just following up on Senator Kennedy's line of questioning. So if a tariff was put in place and the prices went up, wouldn't that be a one-time event, right? Because after that, it would be baked in. It's just a one-time thing.
So it might well be, as I indicated in my opening remarks, it might well be a one-time event, but that isn't a law of nature. You know, we would want to make sure of that. We were more sure of that back in 2018 because we'd had, 40 years of low inflation. Coming off of a global inflation episode where we haven't fully returned to 2%, it's something it's a question we will approach carefully.
But if the tariff is only put in once and just maintains the flat rate there, then how could that be inflationary in the second year?
Well, because it could be a process of many years. I mean, that's a couple of things are. One is if it comes in quickly and it's over and done, then yes, very likely it's a one-time thing, like an oil shock, a one-time oil shock where the price comes back down, it goes through the system. It doesn't raise inflation, just raises prices once. But if you have a process that goes on multiple shocks for years, for example, or if the shocks are very large, that kind of thing. And I think, again, we have to be conscious of the current situation, which is people haven't seen 2% flat inflation for some years now, and it's different from what it was in 2018 when we had tariffs earlier, when we actually cut rates. Mm-hmm. So I'm not saying we're not reacting at all of this. It's a risk we feel like as the people who are supposed to keep stable prices for the benefit of the American people, we need to manage that risk too. That's all we're doing. We're not deciding what to do yet.
Yeah. So if Senator Warner's comment that a tariff is a tax, would that imply that then taxes could be inflationary as well?
No.
So what's the difference between a tax and a tariff then? Or do you disagree with Senator Warner's characterization that tariffs are not taxes?
I wouldn't disagree with that, but it's not the language I use. Look, this is, as I say, one time could be the base case, but in a situation like this where the process could go on for a long time, where the effects could be large or small, it's just something you want to approach carefully in a world where inflation is not back to 2%. And that's our job. If we make a mistake here, people will pay the cost for a long time. And so we're just approaching the question carefully. That's all we're doing. You know that, a majority of my committee has said that they do expect to cut rates between now and the end of the year in the remaining 4 meetings. So it's not that we're, taking a strong view that it will be inflation and not a one-time cost increase. It's just that we're going to take a careful approach to that very critical question.
Well, let me switch gears on you a little bit. Communist China is our single greatest threat to America's national security and financial independence. Now more than ever, the U.S. must ensure security of our financial system against Communist China's malign influence. And in 2022, Senate Homeland Security and Government Affairs Committee released a report identifying efforts by Communist China operatives to infiltrate the Federal Reserve System. The report contained real-life examples of Communist China's attempts and tactics used to target Federal Reserve officials. In late January, a former senior advisor to the Fed Reserve was arrested on charges that he conspired to steal Federal Reserve trade secrets to benefit and advance Communist China's interests. This Wall Street Journal article from May 2025 details the potential ramifications of his actions. The kind of data and trade secrets that this Fed Reserve employee shared could allow Communist China to manipulate the U.S. market and gain advanced knowledge of changes to the federal funds rate. It could provide Communist China with an advantage when selling or buying U.S. bonds and securities. Chairman, has the Fed Reserve made any changes to strengthen its internal counterintelligence and security protocols since the development of these incidents?
So that's an incident, and I would say we take it very seriously. We have quite elaborate and serious and strict provisions around staff access to information, serious protections for confidential information. We have background checks. We have annual training. We have many of those things. I don't know that we've made any fundamental changes, but we're certainly, sorry, very sorry to see something like this having taken place. We're certainly looking at the protections we have in place.
Great. Well, I have another question, and we'll just submit as a QFR, but I know the chairman said you've got a heart out, so I'll go ahead and yield back my time. Thank you, Mr. Chairman.
Thank you. Senator Van Hollen?
Thank you, Mr. Chairman and Chairman Powell. Good to see you. I want to start by acknowledging the continued uptake of the FedNow real payment system. I know I've raised the development and rollout of that system with you in many, many hearings over many years. We're now about 2 years after launch. I want to continue to work with you and your colleagues to encourage expanded adoption of the capability and capacity so that customers have real-time access to their money. So I just ask that we continue to work on that together. You agree?
I do.
I thought you might. Thank you. So I want to ask you about the student loan situation in the country. And you've talked about this in the past, and you've talked about how it can be a drag on the economy, especially when it gets to be very high in terms of balances that cannot be paid. According to the New York Fed, student loan balances grew by $16 billion to reach $1.63 trillion in the first quarter of this year. Data shows an uptick in the student loan delinquency rate overall, the age of delinquent borrowers, and the number of newly delinquent borrowers. The Department of Education, meanwhile, restarted debt collection activities last month, and starting in July, nearly 2 million borrowers could see their wages being garnished. Meanwhile, here in the Senate, President Trump and Republican senators are working to pass this piece of legislation that would limit affordable loan repayment options and make it harder for borrowers to responsibly repay their debt and get back on a path toward financial health. So, Mr. Chairman, you said before in your testimonies that student loan debt can negatively impact borrowers' ability to fully participate in our economy, and that it can weigh down on the economy overall. Is that still your view?
Yes, it is.
And could you just share your assessment, just from a factual perspective, about how this problem seems to be growing at this point in time, and what would happen if we allow all of these borrowers to default?
So the point I was making, I try hard not to comment on things that aren't Fed policy, but I broke that rule in this case many years ago, and so I'll just say what I said then, which is, you can make all kinds of investments, and you can discharge if you can't pay back the loan, you can discharge it in bankruptcy. The one exception we make is student loans, and I ask whether that is wise national policy. People borrow to invest in their education. That we do not forgive. It seems like something for Congress to consider, that's all. It's none of the Fed's business, really. Ultimately, it's not a big macroeconomic thing, but I've said it before. I said it again.
Mr. Chairman, I appreciate your breaking your own rule before, and I appreciate your
I won't do it again.
now. I could not agree with you more about the anomaly in the ability to discharge a debt in bankruptcy. The idea that student loan sort of is the one category of debt that we don't allow to be discharged is confounding. I think, unfortunately, so far, it's been a sign of the power of some of the companies involved in that area. And I just came from another committee where I'm the ranking member, so I apologize if you already talked about the tariff situation. But I know this was obviously a factor that you all had to consider in making decisions about changes in the interest rates. Obviously, there's a lot of uncertainty in the economy. I hear it every day from Marylanders. We have the Port of Baltimore. We have lots of small businesses that rely on tariffs. You're an economist. You know that increasing tariffs is like increasing taxes across the board. But can you just speak to the uncertainty component of all of this and how that is weighing on people's decisions?
So surveys show very widely that people feel uncertain about the economy, and they do point to tariffs in that answer. I will say, though, that actually peaked back in April and has come down a little bit. And if you talk to businesses, I talked to an unusually large number of business people in the last couple of months, and the feeling is a little better now than it was. They're getting on with it and feeling, I'd say surveys are still showing depressed sentiment, but it's moved up from where it was.
I would say, Mr. Chairman, that may be the case at this moment, but we all know that we could wake up any morning and see another tweet, and that could change dramatically. So I appreciate your efforts to try to do what you can to meet your dual objectives at the Fed. Thank you, Mr. Chairman.
Yes, sir. Senator Lummis.
Thank you, Mr. Chairman, and thanks, Chairman Powell, for being here today. As you know, what always vexes me, and has for the last 4.5 years, about the Federal Reserve is the bank supervision function as opposed to the monetary policy function. So I'm going to focus on bank supervision. First of all, I do want to thank you and Vice Chair Mickey Bowman for ensuring reputation risk has been removed from the bank supervision process. It was very arbitrarily used by those who were supervising. On January 27th, 2023, I'd call it the high watermark for Operation Choke Point 2.0. The Federal Reserve Board, in coordination with President Biden's White House, executed a coordinated attack to isolate the digital asset industry from the banking system. And while the Fed has taken steps to adopt a more balanced approach to digital assets, which I appreciate, the legacy of January 27th, 2023 remains with us today. So I'd like you to look at this quote. It says, issuing tokens on open, public, and/or decentralized networks or similar systems is highly likely to be inconsistent with safe and sound banking practices. So my first question is, do you recognize this quote?
Yes, not super clearly, but yes, I do.
Because it's from the Federal Reserve Board's policy statement on Section 913 of the Federal Reserve Act, which was formally adopted by the board on January 27th, 23. So now, Chairman Powell, I want to show you another statement, and I'm sorry if you can't see it clearly, I'll read it to you. It's from the Genius Act, which just passed the Senate by a vote of 68-30 last week. And it takes the opposite position to the board's policy statement on issuing stablecoins on an open, public, distributed ledger. So my question is, what has changed about the risk of stablecoins since the board adopted its policy in 2023? And now that the Congress has weighed in, at least the Senate has weighed in and sent the Genius Act to the House, does the board plan to withdraw the policy statement on Section 913?
So I think what has changed is, if you go back, that's a couple of years ago, that was the period of high-profile failures and fraud and that kind of thing. And what's happened is, I think, the industry is maturing, our understanding of it is improving, and in a sense, it's becoming much more mainstream. So all of us are revisiting, the things that were done during that era, and I think the current view is that that it's appropriate for. It's always been appropriate for banks to choose their customers and to be able to undertake activities as long as they're safe and sound. In terms of, I think I have to get back to you on 913. I think it's a broader thing that has nothing to do with crypto, but that was a piece of it. We are looking at and withdrawing many of our pieces of crypto guidance from that era, though, as you know.
And I appreciate that. I hope that by withdrawing the guidance, that you're also instructing and admonishing your bank's supervisors to when there are efforts to regulate banks that provide too much discretion to bank regulators, to pick winners and losers from among the customer lists, the loan portfolios of banks. It's antithetical to the American system of banking. And I do think that there was that kind of discretion unleashed on banks, and it had a negative impact, a real chilling impact on banks as they selected and banked certain industries and then debanked other industries and other people during the last 4 years. So taking the guidance documents and policy statements out is important, but also guiding the people that there are changes now and that they can no longer use their own subjective biases towards DEI and ESG and other things in supervising the banks is also a critical component of bank regulation.
I agree completely, and as you know, Vice Chair Bowman is actually a former bank supervisor, so she's very well placed to make that happen.
And I realize that she as vice chair is more directly involved in bank supervision. I hope that you will use your role to punctuate the importance of those changes within the bank supervision function at the Fed.
We're going to have to move on.
Thank you.
I'm assuming your answer is yes. Senator Smith.
Thank you, Mr. Chair. Good morning, Chair Powell, and welcome to the committee. So, Chair Powell, a few months ago, you issued a warning about the trajectory of our national debt. Speaking at a New York Times event, you said the U.S. federal budget is on an unsustainable path. The debt is not only at an unsustainable level, but the path is unsustainable, and we know that we have to change that. Would you still agree that that is true?
Yes, that's the one thing that I would always say, and that my predecessors have said, and that's kind of the only thing we say about fiscal policy.
Exactly. And I would agree with that. At a time when Americans are struggling to figure out how to afford their lives and have low confidence in the economy, to add to the deficit now, as the big beautiful bill does, just strikes me as unsustainable. Now, I'm not asking you to moderate between Republican and Democratic policy differences on the big beautiful bill, but would you agree that the big beautiful bill adds to the deficit based on the data that you've seen?
I'm just not going to comment on the reconciliation.
Okay. Well, I will just point out to my colleagues that the CBO says that it adds to the deficit. The Joint Committee on Taxation says that it adds to the deficit. The Yale Budget Lab says that it adds to the deficit. The Committee for a Responsible Federal Budget says that it adds to the deficit. The Penn-Wharton budget model says that it adds to the deficit. And even some of my Republican colleagues, Senator Johnson, Senator Paul, say that it adds to the budget. And as Senator Johnson says, it's wrong and immoral. So I appreciate that you won't comment on any of this, but let me just ask you an economic question. Can you talk a bit about what impact a rising deficit has on our goal of lowering costs for Americans, especially in the Trump tariff environment that we are in right now?
I'm sorry.
What impact does a rising deficit have on our goal of lowering costs for Americans, particularly when we are in this Trump tariff environment, the unpredictability of that?
So I think it's likely that when markets are pricing longer-term Treasury securities, there's something baked into that in the market's thinking about interest rates. What should be the appropriate interest rate? But it's hard to unpack that with any precision.
These are factors that have lots of interplay between one another.
Yes.
Yes. And Chair Powell, could you just comment briefly about the potential risks of stagflation, where we have slower growth and higher inflation? I know this is something that the Fed guards against, and could you just comment a bit on the risks of that and what it means for regular Americans trying to afford their lives?
So we're not seeing that now.
Yeah.
It isn't really the base case that that's what we're going to see. But of course, that's a very difficult thing because, a stagnant economy wants more stimulus, but an economy with more inflation wants less stimulus. So it puts the central bank in a hard place. We've warned of it, but it's honestly not something that we're facing or that we expect to face. But it's it's something we're monitoring is what's happening.
Thank you. I want to follow up on a question I asked you the last time you were before the committee. I asked about the impact of severe weather events, otherwise known as climate change, on home insurance costs. And you testified that, I think you said, if you fast forward over 10 or 15 years, there are going to be regions of the country where you can't get a mortgage because of the, can't get a mortgage because of the impact of the challenges of insurance companies just not being able to provide that. Since February, when I asked you that question, home insurance rates have continued to climb. A recent analysis about climate risk from First Street found that financial burdens from severe weather are driving up household costs and triggering increased mortgage defaults. Now, it's at about 8% now, but they project that by 2035, 30% of all foreclosure losses would be related to climate impacts, which is pretty stunning. Now, I realize this is a complicated issue because insurance is regulated primarily at the state level, though there are exceptions. Flood insurance and terrorism insurance are exceptions. But I wonder if you would comment on this. I'm thinking a lot about what impact this has on housing costs, which is a big component of inflation and a place where housing costs are rising higher than the general inflation rate right now.
Many things are driving up housing costs.
Yes, that's true.
It's of course mortgage rates, but it's also zoning costs and things like this for properties that are near the water. Particularly, for example, we spend some time down in Florida. Property insurance just gets more and more and more expensive, and to the point where it also almost makes sense to self-insure, and that's because of just big losses. Companies are just putting that in their models, and they're charging what they need to to charge to make a return. And if they can't get that, then they'll leave that state. So that seems to be what's happening.
I know I'm out of time, Mr. Chair. Thank you.
You're always polite. So
Minnesota
gave her
knows.
22 seconds. Yes. Thank you,
That's why
ma'am.
they call me the Velvet Hammer, sir.
I didn't say that you weren't harsh as well. You're just nice when you do it, like just right now. See, Senator Moreno, remind me not to give Tina a compliment in the middle of the back.
Chairman Powell, just want to make certain I understand this correctly. Control inflation and maximize employment. That's it. Two things, correct?
Yes.
So let's take one at a time. Maximize employment. Do you care if every American makes minimum wage or makes a livable wage? Is that something that factors into your thought process? In other words, we have full employment, but most Americans are on substandard wages. Does that change your calculus?
Does it change my what?
Calculus. Does it? Do you care? In other words, is it full employment is full employment? Every American has a job, but they're making minimum wage versus having a family-sustaining wage. Does that matter to the Federal Reserve?
It would matter to the country a lot.
I'm saying, does it matter to the Federal Reserve when you're making your decision?
Honestly, we don't really have the tools to affect that.
Right. So it doesn't factor in. Now that's different than us. The people of this country elect us to make certain that their wages are higher than inflation. And by the way, let the records show that real wages are up this year. So we've done that, not the Federal Reserve. Second piece of it is, let's talk about inflation first.
Well, we've helped control inflation, which is part of that.
We're going to jump right into the inflation conversation. There's different kinds of inflation. There's different causes. There's not witnesses to inflation. There's key actors to inflation. Would you agree?
Sure.
Okay. So let's talk about the actors. Did you comment during COVID lockdowns that was a bad idea, meaning that you're shutting down the entire economy? It's not a button. I hit the button, you can hear me. It's on and off. COVID wasn't that. We just shut down the economy. Any comments on that?
Of course not.
Okay, so you didn't comment on that. Vaccine mandates, something that my Democrat colleagues loved. If you don't get the vaccine, you're a terrible human being. You can't go to work. In fact, Joe Biden was overruled by the Supreme Court because he said that if you work in a company with more than 100 employees and you don't get vaccinated, the company has the ability to fire you, unless you prove that you're negative on COVID. That obviously is a supply chain shock, wouldn't you agree? If I'm running an assembly line and now I have to put my people 6 feet apart and Now I have people quitting or not coming to work, or I have to fire them. That's a supply chain shock. Wouldn't you agree?
I mean, it's a medical thing that you
No,
take.
but it's a supply chain shock.
George Washington
I'm not asking you to make a medical decision. I'm asking you to make a Fed decision on inflation.
way outside anything we would comment.
But it affects inflation because supply.
It didn't, in
Are you,
fact.
are you, wait, are you saying that supply
Didn't.
chain shocks don't affect inflation?
They do, but that
Okay, they
one
do.
didn't.
So that's clearly one. If you ban the export of liquid natural gas, which is going to cause the commodity price to go up, would that supply shock not also cause inflation?
Potentially could.
Yeah. So, and now the ranking member loves to talk about billionaire corporations, that are going to get away with paying taxes, right? Who pays corporate taxes? Like, who pays it? Is it like some obscure Wizard of Oz character behind the curtain that is a corporate entity that pays taxes? Who pays taxes?
I mean, ultimately, it's shareholders and customers.
So it'd be, I'm going to read you a line. You tell me this is accurate. On taxes, it's not possible to know in advance precisely how the costs will be shared for taxes. I added
Correct.
that.
I would
But
agree.
it is highly likely that consumers will pay a meaningful share. Meaning, if the ranking member has her way, let's just tax corporations at 100%. Why not? Be fantastic, right? Oh, nobody would want to start a company, but that aside, that cost would be added to consumer products, correct?
A tax or a tariff? What are you talking about now?
If the income tax for American corporations goes up, they will share that tax burden with their consumers. True or false?
Yeah, ultimately.
Yeah. So then taxes do raise inflation, but you don't comment on.
I mean, they haven't,
and
though.
you
That's
don't.
just-
but
that's
you
just
don't.
not true. I mean,
got
empirically, it's not true.
The chairman's going to beat me up in 56 seconds. So, but you sent me a very nice letter, which I appreciate, and it says the Federal Reserve plays no role in commenting on trade policy. So you don't comment on supply shocks. You don't comment on tax policy, which clearly affects inflation. You don't comment on demand pull. You just said now that we should forgive student debt. Why is a person that goes to Harvard, that gets a gender studies major, pays Harvard obscene amounts of money because professors are grossly overpaid there, is that person better than a working class Ohioan that is a plumber but can't afford a car because interest rates are too high and car prices have gone up? Why don't we forgive that person's car loan instead of forgiving their student loan? But you don't comment on that. You comment on tariffs. So I'm going to just show you.
I don't comment on tariffs at all, actually. I comment on
only
inflation.
commented on tariffs. You've
I'm
only
not commenting
commented
on the
tariffs.
wisdom of tariffs.
Look, the chairman's over there in the conversations. I'm going to show you a chart here. This is car prices.
I'm paying attention, however. You're
This
down
is
a lot
car
of time.
prices since this year. Car prices are down. Car prices are down. Inflation in America is down. We got elected by millions of voters. You got elected by one person. He doesn't want you to be in that job. And you are costing this government $400 billion a year by refusing to lower interest rates. Nobody in this chamber has that kind of power to have a $400 billion impact on this economy, on our deficit. And I just think that you should consider whether you're really looking at this from a fiscal lens or a political lens, because you just don't like tariffs.
Senator Warnock is next. Thank you, Chair Scott. Thank you, Chair Scott, and thank you, Chair Powell. Good to see you. The United States national debt currently exceeds $36 trillion. Last year, we paid nearly $1 trillion in interest on the debt alone, more than the federal government spent on educating and feeding our children. Chair Powell, how does the Fed consider rising national debt levels during discussions about adjusting interest rates?
We really don't. We take fiscal policy as completely exogenous, and we look at the data that's coming in, but we don't, we're never going to take into account budget deficits and things like that.
Well, here is my concern. Maybe Congress should be thinking about it. The world is losing faith in America's ability to repay our debt. We have seen a sell-off in the bond market. The United States dollar has lost more than 10% of its value against the euro and pound, and is down against nearly every single major currency in the world. Back in May, Moody's downgraded the U.S. government's credit rating because of growing debt and sinking confidence in lawmakers' willingness to address this issue. Historically, high debt pushes up interest rates, slowing economic growth and setting up a dangerous debt cycle where both interest rates
and debt continue to rise. Chair Powell, how does the size and the trajectory of the national debt affect the Federal Reserve's ability to manage inflation in good economic times and spur investment and hiring in slower economic times?
I'm happy to say that today, those things do not affect our ability to do our job. The concern really is that if we don't do something, then there will come a time at which it will be a problem, not for us, but for the country. But that, at this time, it does not interfere in any way with our ability to do
That is a realistic concern in the future, given the rate of increasing debt. And it's something I'm concerned about, and maybe because it's in the future, maybe that's why, folks who have power, who sit in these jobs, aren't as concerned about it as perhaps the Congress should be. I'm concerned about it as a father of a 6-year-old and an 8-year-old. I'm concerned that my Republican colleagues are planning to ram forward a bill that, according to the Congressional Budget Office, will increase the deficit by $4.2 trillion. So I want us to think about that. We're taking food out of the mouths of hungry children. This bill could cut as many as 16 million Americans off of health care. When we think about Medicaid, 71% of the Medicaid recipients in Georgia are children. So we're taking their health care, and then we're saying to these children that you'll have to deal with these trillions of dollars in debt one day. $4.2 trillion increase. Senate Republicans are trying to use a budget gimmick to claim the bill only costs a fraction of that by simply not counting things they don't want to count. If they don't like the math, they just change the formula. But the markets and those investing in our country don't care about these budget tricks. And I don't think it will help my 6-year-old and my 8-year-old when the bill comes due on this. They know the truth, and they will react based on the truth. The big ugly bill will put the United States on a disastrous fiscal path, and it will be catastrophic for our economy. Even worse, the big ugly bill is cutting people off of their health care, and for what purpose? To give tax cuts to the wealthiest. So this is an interesting moment for me, for someone who didn't know I'd end up in politics, or just paid attention to politics over the years. They're getting ready to create a whole lot of pain for a lot of people. And the question is, for what purpose? To give billionaires a tax cut. I think we ought to work together to prioritize extending tax cuts for the working class. We shouldn't be cutting their health care. We ought to save the country trillions of dollars by not giving more tax breaks to the richest Americans. And if we try to work together, we can save our economy from this disaster and still protect working families from a tax hike. I believe in tax cuts. I think working class Americans ought to give them, ought to receive them, and we ought not be burdening our children with all of this debt. With that, I yield, and the chairman should take note that the Baptist preacher is done with 3 seconds left.
And the people said amen. Okay. Senator Hagerty.
Thank you, Chairman Scott and Ranking Member Warren, for holding this meeting. And Chairman Powell, it's good to see you here again. Chairman Powell, I want to talk with you about inflationary and deflationary trends in our economy and how they impact your thinking. I understand, based on your testimony and recent statements, that you're acutely sensitive to the inflationary risks of our administration's trade policy. And though I note that it's not the Fed's responsibility to attempt to steer or to directly offset that policy in any way, I look at that, I look at your perspective, but I also look at many of the other developments in our country that I think present the opposite risk, which is a disinflation risk. And let me dig into this a bit. We're witnessing artificial intelligence adoption at breakneck speed. That's going to bring about productivity gains in nearly every aspect of our economy. We're about to pass a tax bill. That tax bill is going to encourage capital expenditures and long overdue upgrades to our manufacturing capacity, again, increasing productivity. And if you think about the concerted effort that's being undertaken by our federal government right now to reduce waste and bloated, unproductive government payrolls, all of these point to disinflationary productivity gains. So given the competing sources of uncertainty that we're talking about, it feels to me like the Fed's far more focused on tariffs and the inflationary impact of tariffs than on the deflationary impact of the points I just mentioned. So if uncertainty around tariffs is the primary reason that impacts your thoughts, I mean, how do you counter, how do you bring into account these disinflationary trends that I've just mentioned?
So we do look at the overall picture, and that's actually what's been happening is services inflation's been coming down, and that's been covering what we see so far, small increases in goods inflation. I would also mention a factor that you didn't mention on your list, which is regulation, which is an area which could also be over time disinflationary. Yeah. So we get that. I mean, I try to say that it's the broad sweep of policies and the broader economy that matters for inflation. I get asked about tariffs a lot, and that's the one where all forecasters are expecting, a significant increase between now and the end of this year. We don't know how big it's going to be. We don't know when it's going to come, but it's just something that we're waiting to see more information on so we can make a better decision on interest rates. That's all it is.
Well, I hear the discussion about not knowing the magnitude and the timing of the trade talks and the resulting tariffs that will ensue. It does seem to me that there's a bias toward viewing this as more inflationary than deflationary. And I'd like to ask you this. If Ambassador Greer is successful at bringing the trade deals together soon and alleviating that uncertainty, what would that do to your perspective on rates? Would that put you in a position to think more aggressively about lowering rates?
Yes, potentially it would. I mean, really, it's reducing uncertainty would help, and also just what's going to be the final tariff rate and getting that settled. And I think that's the path we're on.
I think that's welcome news. I think the markets will welcome that as well, because I do believe that we're on the path, as you're about to say, of having some significant resolution in trade uncertainty. We've lived in an unbalanced world for years, where the United States has had the lowest tariff barriers in the world, and other nations have taken advantage of that. Jameson Greer and this team, Scott Bessent and his team, the president, everyone is making a concerted effort to fix this. So I'm looking forward to that. One other area I wanted to touch on, because it's touching close to home, and that is legislation that this committee has just passed out and that we've just passed in the Senate. That's to do with the Genius Act. We just passed it last week, and it provides an urgently needed regulatory framework for payment stablecoins, and it requires that they're backed one-to-one by cash or short-dated U.S. Treasuries. Over the last 5 years, the total value of outstanding stablecoins has increased from approximately $4 billion to over $2 billion today. One market participant has predicted that if a framework like the Genius Act is adopted, total issuance of dollar-pegged stablecoins could reach nearly $4 trillion by the end of the decade. So I wanted to get your perspective again, Mr. Chairman, of what impact would this new source of demand for bills have on the yield curve, and in particular, what impact would it have on short-term rates?
So more demand is going to have a tendency to drive down rates. I don't really have a sense of how big that effect would be, of course. And let me just say that it's a great thing that we're making progress toward a stablecoin framework.
Thank you, Mr. Chairman. I couldn't agree with you more. The direction clearly is that it's going to drive rates down. I think it's very positive for the economy, positive for our cost of borrowing as a nation. And I appreciate your response there, Mr. Chairman. Thank you very much. For the
Yes, sir. Senator Cortez Masto.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you. Thank you for being here. I want to follow up on a question from Senator Warner about data deterioration. I'm concerned about that as well. That the Trump administration, I'm watching as they've ended dozens of research studies that business and government leaders rely on. So my question to you, are there specific research projects that the Bureau of Labor Statistics provided that they no longer do provide, that the Federal Reserve researchers cannot replicate on their own or through other sources?
I'm not aware of any.
Okay.
That doesn't mean they don't exist, but mainly it's the regular data they supply. And as you know, they've cut back on the size of that survey.
Right. So I would hope as we move forward, and not just in today's hearing, but if there is some other data or you're relying on data that you're not getting, or there's now another source for that data, I would please share that with the committee. Thank you.
Yes.
During the Biden administration, the Federal Housing Finance Agency and the Federal Reserve worked together to improve access to the discount window for banks. What is the status of that collaboration with the FHFA?
I can't speak to the FHFA. I can speak to the fact that we're really looking carefully at modernizing the discount window and making.
But we're not there
investments.
yet?
No, it's going to be, this is a project that will take some time. It's the discount window needs to be updated and refreshed from a technological standpoint so that people can access it readily and that kind of thing. It's still a little bit behind the age in that respect.
Do you have a time frame that you're looking at to?
I'll get back to you. It's
Okay.
something we've been working on hard.
Or is there a funding impediment that is also
No.
addressing this?
No,
So, okay,
no.
if you could.
We're moving
provide-
ahead with it. I'll come back to you
Okay,
on that.
thank you. In March, the Federal Reserve, together with the FDIC and OCC, announced that you all intend to repeal the 2023 Community Reinvestment Reinvestment Act proposed rule. I prefer the proposed rule as it would better address the needs of states like Nevada that don't have headquarters of large banks. How will you ensure that the new CRA guidance improves access to financial services, to loans, to investments in underserved rural and tribal communities?
So I think in March, we announced that we're putting out for comment really a proposal to withdraw the proposed guidance, which had
Okay.
been the subject of litigation. And in the meantime, we're going back to the old CRA rules, and I think that's where we will be. I don't have anything more in terms of what we might change with respect to those old rules, but that's where
So
we
the
are.
default are the old rules, and
Yes.
those may be.
CRA as it existed before
ongoing.
this
Yeah.
proposal, which actually never took effect.
Right, okay, that's helpful. Community banks benefited from high deposits during the pandemic. Since then, the net interest margin for community banks has fallen. What specific challenges do you see for community banks, if any?
Community banks, are very important. We want a banking system that has all different sizes and shapes of banks, and community banks are absolutely critical. They know what's going on in communities and in a way that the big banks can't possibly. So they're a critical part of our infrastructure, and I think they've been under pressure because, frankly, fixed costs of regulation have gone up. We try not to contribute to that. The number of banks has been going down pretty steadily, and that's not something we're trying to foster, but it's a sort of long-run trend of really the last 30 years. So we try not to add to what is a secular trend because we think they're important.
Thank you. Thank you for being here. Appreciate it.
Thanks.
Ms. Chairwoman, I yield my time.
Who's up next? Senator Britt.
Thank you very much, Madam Vice Chair. Chair Powell, thank you for being here with us today. I want to start just by echoing the comments of Senator Cortez Masto when it comes to community banks. Obviously believe that community banks and credit unions, financial institutions that serve everyday Americans and main streets across the great state of Alabama and our country are so critically important to people being able to actually achieve the American dream. And want to make sure, I know we've talked about this the last few times that you've been in front of us. We've talked about the rewrite of Basel III. We've talked about long-term debt. We've talked about Reg II. We've talked about a ton of things and talked about my concern that no one was looking at the cumulative impact of those things and the trickle-down effect. I just want to get a commitment from you that as you are reviewing rulemaking across the board, that you will consider and make sure to make the perspective of the smallest U.S. banks and non-financial industries like the ag sector who did not maybe have a seat at the table in previous administrations, but give them a seat at the table and make sure that you're thinking about the impact on those individuals and the people they serve.
I'm happy to make that commitment.
Thank you so much, Chair Powell. I also want to talk to you about an issue that has been brought up briefly today by another colleague of mine, but that is about childcare. So when we look at the childcare crisis in this country, we know that our economy loses about $122 billion a year because of affordability and accessibility, reliability, if you will, of childcare. It is said that anyone who has a child between the ages 0 and 5 actually spends 22% of their income on childcare. We have done the studies and looked at the numbers, and 59% of stay-at-home and or part-time working parents say that they would like to re-enter the workforce, but that affordability or accessibility is an impediment to do that. As we are looking to build back America, as we are looking to create opportunity and bring those things into fruition, would you agree that taking a look and being able to address, not asking you to comment on any specific proposal, but addressing some of the shortfalls related to accessibility and affordability of childcare would have a positive long-term impact on the economy?
So I think there's quite a bit of research showing exactly that, and we really saw it during the pandemic. As I think you know and have pointed out, it's not an issue that we play a role on, but clearly it would contribute. Childcare would contribute to participation in the labor force by many.
Absolutely, and as Alabama looks, we look at our labor participation rate. It is 5 points lower than the national average. We continue to look to ways to get people re-engaged in the workforce and know that addressing this head on will help us be able to achieve that. So thank you so much, Chair Powell. I look forward to continuing to work to get that done. So there has been some angst vocalized about the reconciliation bill and the president's trade policies. And from my perspective, much of that skepticism is both unfair and premature. Market resiliency and recent economic data actually continues to reflect confidence in the U.S. economy. Look at the recent Treasury auction, which was notably successful and saw stronger than expected demands for 30-year bonds and stable, even slightly declining yields. To me, this demonstrates that investors still view the U.S. debt as an attractive asset, regardless of the ongoing policy discussions and debates and forging a pathway forward. And those fundamentals of the economy, actually remain quite strong. Chair Powell, would you agree that the components of our economy actually remain quite strong? And how does the Fed consider this type of strong auction performance in the context of your market expectations and monetary policy discussions?
So, as you point out, the Treasury market is working fine just now. Liquidity is adequate, and bond prices are responding to economic events, and so bond market's in good shape. In terms of the strength of the economy, I would strongly agree. The labor market's in a solid place. The economy's growing. Inflation is in a pretty good place, come much closer to 2%. So it's a very solid economy. We are watching the labor market very closely, as we always do. And a couple of things in particular. One is just a very low hiring rate, which goes with a low layoff rate. But if we were to start to see layoffs, we would see unemployment go up quickly, and so we're watching that carefully. But the labor market has remained solid, and I would agree with your overall characterization.
Thank you. Appreciate you being here today.
Thank you, ma'am. Senator Kim.
Yeah, thank you, Chairman. Thank you for coming before us today. You've often said in the past that when it comes to monetary policy that it works with a lag, right? That this is something that you're having to try to assess the data that's before you.
Right.
I'm thinking about this because we have the Federal Open Market Committee, FOMC 5-year review, and you were talking about tariffs and the uncertainty of this moment. So I guess I just wanted to ask you, how do you balance sort of assessing between more of the backwards-looking data that you're able to look at more tangibly in that way, but also addressing sort of forward-looking models to try to understand where things are heading?
That's really the challenge that all forecasters have, and really monetary policy needs to be forward-looking. At the same time, we need to be humble about our how hard it is to forecast. So particularly at times of high uncertainty, which I would say I would include now, you really want to look at the real data and take signal from that, and not be too brave about what your forecast might be, because it's going to be highly uncertain.
So you're saying that in times of greater uncertainty, in some ways that makes you more interested in the backwards-looking data to sort of guide you?
Well, I'd almost flip it around. Yes, but I'd almost flip it around and say at a time like that, you don't want to be giving a lot of forward guidance, and you don't want to be acting as though you have a lot of certainty about the path forward. It makes sense to move more slowly in most situations where there's more uncertainty. There are situations where it would not make sense to move slowly, but in most cases, you'd want to move more slowly.
Yeah,
it's
that's
uncertain.
interesting. I mean, I talked to some of my constituents back home. There's this one conversation I always had, that has really stuck with me, where, a woman was telling me that, there's so much uncertainty right now in the world and certainly in her life that she says it's hard for her to even breathe sometimes. She just feels this kind of weight upon her chest. And I've thought about that a lot because I try to think through what can we do to try to alleviate that concern, alleviate that anxiety for people. But you can see it. I mean, right now, whether it's about what's unfolding in the Middle East and the fragility of what comes next, when I look at this reconciliation bill before us in the Senate, I do worry not just about the deficit, as some of my colleagues have mentioned, but about the potential of significant job loss that we're seeing, whether in the healthcare industry, whether in the energy industries. And certainly when it comes to tariffs, as you said, trying to think through what comes next in terms of whether deals are struck and at what levels. Are you taking into account that by sort of an issue-based level, or are you looking at sort of the global instability in terms of the different crises that are out there? Is that factoring into how you're thinking about when we're talking about legislation here? I know you're not going to go into the policy per se, but if there's a potential for significant job disruption, is that something that you're looking into as you're forecasting?
Yes. We obviously pay great attention to global events and in an effort to understand what's going on in the economy globally, because that does matter for our economy. So we pay close attention to all of those things and track them. Ultimately, though, we're looking at the U.S. economy and what are the fundamental drivers here, and then making a judgment based on all of that. And mainly, this is a big economy, and we're geographically separated from most of the other big economies in the world. So we have a smaller external sector than most of the all the European economies, for example. So we're really looking at the U.S. and what's happening here.
I wanted to ask you because, in central banks in other countries, including Bank of England and European Central Bank, they've begun modeling the potential macroeconomic effects of artificial intelligence. They're thinking about how they can use AI to be able to do some of the forecasting, to think through what comes next. I guess I wanted to get a sense of what the Federal Reserve is thinking in terms of similar work in the AI space.
We have lots of people doing work on AI and more than that, even monitoring research that's going on everywhere in the world. And, speaking of uncertainty, it's very clear that it has the potential to make really dramatic changes in our economy, in our workplace, in the jobs of workers, in the way companies work, and all of those things. But it honestly, there's a tremendous uncertainty about the timing of that and what the ultimate consequences will be and what the medium-term consequences will be.
I was wondering if the Fed is evaluating AI credit models and how that could potentially deepen disparity in credit access or violate fair lending standards. Is that something that you've looked into at this point? And
yes, absolutely.
Is the Fed looking to potentially affirm some industry standards on this?
It's something we've been aware of for a long time. There's a lot of research that's been done. Before generative AI came along, it's also just machine learning and technology generally. You need, there are implicit biases that can appear. It's something we're very well aware of, and we do work with people to make sure that doesn't happen.
Okay, thank you. I yield back.
Thank you. Senator Banks.
Thank you, Mr. Chairman. Chair Powell, can you talk about how our interest rates compare to other first-class countries around the world?
At the higher end.
And how does that affect the United States?
Well, I think that reflects a couple things. One is just that the U.S. economy has outperformed, has been stronger than others. And I don't want to pick on any other nations, but many other nations have had much lower growth, now have lower inflation, and are, have pretty low growth, whereas the U.S. economy has really been the outstanding performer and remains that to this day. That implies somewhat higher rates.
So you say it's higher than most of first-class countries. Can you talk about historically where we've matched up with other countries?
Yeah, so let's just go back to when the pandemic hit, for example. We were we had very low rates during that era, but they were by far the highest in the developed world because the U.S. economy was the strongest. The European Union had negative rates. I think the Bank of England was at 75 basis points. I think we were at 2.4%, so we were meaningfully higher. And again, it was a time when we were just our growth was higher, and their growth was lower, and their inflation was lower. Our inflation was fine, probably about the same as ours. So I think we've generally had a little bit higher rates than those countries because they have slower growth, older populations, lower productivity, those kind of things. We have the
Have those
strongest
interest
economy in the
rates
world.
globally gone up as well?
Sorry?
Have interest rates in those countries globally gone up as well?
Well,
Just not as
they
much
went
as
up.
the US?
All of those countries had their rates go up quite a bit during the global pandemic inflation, right? And as you know, many of them have been cutting their rates, and we had been too, and we'll at some point resume that. But we're 100 basis points lower than we were. I think if you take the EU and the Bank of England, they've both cut a little more than that.
How recently?
Recently, but but I think you probably read this, but they're either at or close to the end of their cutting cycles.
I know there's been a lot of talk today about deficits and the national debt, but how much does tax policy affect the economy in the U.S.?
I mean, it has big effects over time. It's really not something that drives what we do. It isn't. But I think tax policy plays over the long run a huge role in incentivizing investment, which helps growth and things like that. I think it's very, very important over the long run. Certainly more important than monetary policy.
Would a $4 trillion tax increase on middle-class Americans affect the economy?
Now here we're getting into the bill.
I understand. I'm asking how that would affect the economy and according to your data.
I'm trying to not make any direct comments on the bill today, if you'll forgive me. But I take your point.
Okay, I am trying to make a point, but there's got to be data that you sit on somewhere that would suggest that large tax increases would affect the economy, would stall economic growth in the U.S.
You could certainly get that out of a model if you wanted to. I mean, but again, I'm inevitably going to be commenting on the bill, right? If I answer that question, a
lot of talk today about inflation. You've already agreed that inflation is down from where it was a year ago, and would you say steadily declining?
Has been, yes. I more than agreed to it. I'm very pleased by it.
And all of the experts and so-called experts tell us that tariffs lead to inflation. But you seem to have suggested already that inflation is, if not under control, close to being under control.
So inflation's in a really good place. It is definitely in a good place. And, we have a forecast, and so does, by the way, every other, brand name forecaster in the country, which is very similar to ours, that there will be some inflation from tariffs coming. Not yet, but over the course of the coming months. And I think it's reasonable to expect that because someone has to pay. This is hundreds of billions of dollars of tariffs we're taking in. Some of that's going to fall on the consumer. Not all of it's going to fall on foreign manufacturers. And that's the only insight we have, and we're just kind of wanting to see more data on that before we move.
One final question about data. Our trade deficits with China, the EU, Canada, and Mexico have all significantly dropped recently. What does the data tell us about that?
Well, I think that's
how that would affect inflation.
How it would affect inflation. I don't know that it has implications for inflation, but it obviously reflects the tariffs. I think recently you've seen Chinese imports come down quite a bit.
Thank you. I yield back.
Thanks.
Senator Blunt, Rochester.
Thank you, Mr. Chairman and Ranking Member Warren. Chair Powell, welcome back. Inflation has come down meaningfully from its peak, and there are signs of moderation in the broader economy. But prices for rent and other essential services remain high, and the outlook is still uncertain. Wage growth remains strong, but productivity trends are mixed, and demand for places to live is high, but borrowing costs and material shortages are making it harder for builders to keep up, adding to the affordability pressures. And at the same time, while I know this is not something you would say, but at the same time, while our Republican colleagues are pushing for tax cuts for the wealthiest Americans that would expand the deficit, The administration's trade and immigration policies are also introducing uncertainty that may not yet be fully reflected in the economy. For families that I represent, the cost of living remains painfully high. Premature easing could have unintended consequences that undo the progress we've made. Later this year, the Fed will update its monetary policy framework to respond to today's inflationary environment. And after years of supply shocks, housing inflation, and fiscal volatility, I hope you will remain strengthened that the Fed's ability to navigate the more uncertain economy. And as you undertake this update, can you talk about how you're adapting the framework to these realities while preserving the Fed's commitment to full employment?
I'd be glad to. So we made changes in the year 2020 to our framework, and those were meant to take on board the special issues that a central bank faces during the era of extremely low interest rates, where rates were never very far from zero. In fact, we just barely got away from zero when we had to cut back to zero. And the feeling was very much that if we had any kind of a shock, we'd be back at zero for years on end again. And that's really not a good thing, because the economy can become very stagnant. So what's happened since then, the big thing is interest rates are back to much more normal levels historically. So our policy rate at 4.3% actually doesn't feel like it's particularly restrictive. So it's, in other words, rates have moved way back up. That means that the effective lower bound is less of a problem. It means that the changes we made in 2020 are less relevant. They're not completely irrelevant. So we're making modifications, which we'll be discussing inside of our committee now in the next meeting and in the next meeting, that will return the forecast more to what it was before the 2020 cycle.
I know we had a chance to talk in the past about my focus on jobs and the economy and labor. And I want to follow up on Senator Kim's questioning, where the focus on the changing technology landscape and with artificial intelligence, generative AI, and just its impact on the economy and labor market. How would you describe AI's impact on the economy so far, and how is the Fed measuring it?
The effects of AI are probably not great at this time, generative AI, and the question is how great will they be, and how big will they be, and how quickly will that happen? And anyone who's been exposed to what AI is capable of has to be pretty stunned by what it's capable of. And this is even the early days too. What the experts tell us is that in 2 years these things that you're doing, that'll be nothing compared to what we can do in 2 years. So I think it has enormous capabilities to make really significant changes in the economy and the labor force. And it can either augment people's productivity, or it can replace people, or it can do a little bit of both. Right. But it's going to be something.
You preempted my question, actually. I saw a recent article, and a CEO of an AI company actually said AI could, quote, wipe out half of all entry-level white-collar jobs and spike unemployment to 10 or 20%. And I think he said in like a matter of a year or two. Do you think this is a reasonable perspective, and how would AI-driven productivity gains or worker displacement affect how the Fed defines full employment?
I don't know whether that's, I'm not the person to say how quickly that will happen. What's happened before with technology is it just seems to take a long time to be implemented. There's the technology, what it's capable of, and there's what it actually does when implemented. That last phase has tended to take longer than people expect. Will it happen with AI? It probably will, but in terms of maximum employment, the Fed doesn't have the tools to really address the social issues and labor market issues that will arise from this. We don't have those tools. We just have interest rates, and we'll always be able to balance the labor market so that supply and demand are in balance. But things like what AI does and what other things do from the outside, we just have to take them as they come.
Thank you.
Thank you. I yield back.
Yes, ma'am. Senator Tillis.
Thank you, Chair, for being here. I didn't expect to talk about it, but since AI came up, first off, we need to welcome it, exploit it, and benefit from it. I've had my staff try and go back and look at some of the congressional hearings in the times of the Industrial Revolution and other instances where we've had these threats of displacement, and it worked out okay for us. But the key is this is a global competition, and other countries are going to implement it. It is going to drive down their costs, and it will make us less competitive if we don't meet the challenge and become the innovator. But the transition is I think, very important to note. I want to talk about SLR for a minute. I think you all indicated the balance sheet's going to continue to shrink. We're not going to get to pre-COVID levels, which was, I think, somewhere around $4 trillion. I guess the question is, you guys expect to hold higher levels of central banks to hold higher levels of central bank reserves than we have in previous years. Do you agree with that?
I don't think we'll get all the way back to where we were, but we're still shrinking.
Is it fair to say that the SLR should be updated to reflect the evolving preference?
Yes.
Thank you. Fed now. It's cost $545 million. You know, Chair Powell, I've never really liked Fed now, so it's probably not a friendly question. I spent $545 million to implement it now. I think you're expected to spend another $245 million in 2025, so the total price tag is $1 billion. As you know, the Money Control Act requires the Fed to cover all the direct and indirect costs actually incurred. So can you give me an idea of when we're going to see a fee structure that's going to generate and actually pay for this implementation, including the expected ongoing operational cost?
So you're right. That is our obligation under the law, is to have it be self-funding, and we have a period during which that's supposed to happen. Yeah. Uptake has been steady but not rapid, and usage has been. Is it your
sense that you're going to be able to get to that, and that the fee structure that you're going to need based on that take rate is going to be achievable?
I think it's probably still achievable. I am not 100% clear that we're going to achieve it very soon.
That's what I'm concerned, and I wonder if that pricing is there, given private sector options, if you're ever going to be able to get there. So just an editorial comment. One thing I did want to mention, I'm excited to see some of my colleagues on the other side of the dais concerned about the debt. Because last time I checked, over the 4 years that President Biden was in office, we had the American Rescue Plan that cost us $2 trillion. We had the Inflation Reduction Act that cost us $1 trillion. And we had the PACT Act that many of my colleagues, I was one of 9 Republicans that didn't vote for it, that also cost us $1 trillion. So I'm excited to see that my colleagues on the other side of the aisle want to get serious about spending within our means. I did have a question, I think, for my staff wanted to ask about, sorry, I just want to get my notes right. I actually wanted to go, I don't have it before me, but what's the current status, in your view, on Wells Fargo's capital requirements?
On their capital requirement? Well, I think you mean on the growth cap?
Yeah.
Yeah. So we voted unanimously to remove that after many years of having it in place. They did satisfy the requirements we'd put in place, and we removed the cap along with the other agencies.
And you think your fact-based decision, you stand by it?
I do.
Very good. Last thing is Walmart. I've got other questions I'll submit for the record, Chair, but Walmart on April 9th, I think, withdrew their forward guidance. And they indicated the reason that they were doing that is there was uncertainty, and it seems to have been timed somewhat with the uncertainty around trade. So I would just suggest for my colleagues, I don't know if you can respond to this or not. I won't ask you a tax question, but I really want to. But I know what your answer is going to be. You're a good dancer. I think that it is fair to say that if there is going to be a correlation to increasing prices, and Walmart having made the decision to withdraw their guidance is probably the best testament that they know that they may have to deal with cost and maybe inflationary uncertainties. Would you characterize that as maybe a likely reason that they withdrew their guidance?
It might be, I saw that they had, I didn't have a chance to go back and check why, but
Well,
that's,
if you tease through the language, it seems almost certain that they think that some of their input costs were
Yeah.
going to go up and they need to manage their margins. So I'm just telling my
That makes sense.
colleagues, we just need to be realistic that if you have a major household name withdrawing guidance because of uncertainty, they've got a lot of experts that probably are suggesting there may be some inflationary risk. We haven't realized it yet, but I think we all need to keep our eyes open and not look past it so that we can management if it comes to pass. I don't think that there should be a problem with that.
thank you.
Now, the last thing that I just want to mention is that you can't respond to this, but I will tell you, if the Democrats succeed in preventing us from avoiding the biggest tax hike in the history of this country, it is going to cause great damage to the people who can least afford it. You don't get to respond to this one, but folks.
Senator also Brooks is next.
Oh, I'm sorry. I didn't realize she was here.
Yes.
I'm sorry.
We were allowing
but
him
we
to
need to
stall
open
till you
that.
got
We need
here.
to be open. We need to understand that you will have something to fix if we fail to continue the tax cuts.
Thank you, sir. Senator also Brooks.
Thank you so much. First to Chair Scott and Ranking Member Warren, thank you so much for hosting today's hearing. We thank you also, Chairman Powell, for your tremendous service to our country. I very much enjoyed the meeting that we had earlier this year and look forward to working with you. Many of my colleagues today have been listening to this hearing, have rightly discussed concerns regarding how tariffs are affecting consumers and businesses. And I'd like to highlight a specific business in Maryland that encapsulates the harm that I believe this administration is inflicting, but also the resilience of a proud Maryland small business. Bay Dog is a successful pet brand based on Kent Island, one founded by Barton O'Brien, who's a Marine veteran who served 3 combat tours overseas. Mr. O'Brien has calculated that if he were to make his products in the United States, he would have to raise his prices 400% just to break even. The tariffs, he believes, are a burdensome tax that could put companies like his out of business, but the damage doesn't stop there. Bay Dog is sold in thousands of other brick and mortar stores across the country, all locally owned small businesses who similarly have to raise prices or lose sales to pay the president's tax. Mr. O'Brien started planning for this last summer when President Trump started talking about tariffs during the campaign. He stockpiled inventory and has committed to keeping his prices stable this year. But what Bay Dog is asking is, what is he to do if the tariffs are in place next year? Mr. O'Brien has calculated that he won't have to just raise prices. He'll likely have to cut his staff to stay in business. So, Chair Powell, there are 34 million small businesses in America, 1 for every 10 people. And if small businesses like Bay Dog have to lay off staff or go out of business altogether, what will that do to unemployment in this country, and what effect will that have on the broader economy?
I mean, just mechanically, I don't want to comment on particular tariff policies, but sure, if companies go out of business, then that'll hurt employment and activity.
And what we will see is, of course, and we have so many small businesses, what we're facing now is that very prospect, is that we're going to have so many, and we believe that, the inflation caused by these tariffs will really have a very negative impact. And if this is the case, what would this mean for American workers?
Well, the other thing is, I think the tariffs are still in motion. It's premature to say exactly where they're going to land. So we're kind of withholding judgment until we see more. That's kind of where we are. We haven't made a decision to do anything. It's just we want to see more. And the situation evolves day by day, month by month. So.
Okay. Well, in another question, in our meeting and in your most recent monetary policy report, you spoke of the long-term challenge of housing supply not meeting demand. And I look at this issue the same way I did as county executive, where I really fought hard to leverage private and public sector dollars to bring more housing to communities that needed it. Maryland has a shortfall of nearly 100,000 homes, and the pathway to build wealth is therefore narrowing. So studies have estimated that of the over $200 billion invested annually in housing in recent years, only a fraction supports affordable homes for working class families. So would you speak to the need to better incentivize private investments into affordable housing construction. I'm working with a private sector and nonprofit stakeholders on legislation now, but just wanted to know if you could comment on that.
So I would say this, interest rates are slightly restrictive at this point, modestly restrictive, and that is weighing on economic activity in the housing market sector. But you're really talking about a different problem. It's not one that the Fed can really address, and that is we have a longer run housing shortage. So many other advanced economy countries have this too, and it's not our tool. Our tools don't really work to affect that. It's really elected people, and you saw this as county executive. It's things that the legislature can do that can really address that. Not us. It's not about interest rates.
All right. Well, now I understand one other issue. The Fed is evaluating the leverage ratio rules regarding the amount of capital required to be held by banks to withstand unforeseen risks. And I'm hoping you can then provide some insight as to what potential changes this framework are meant to achieve. On the other hand, I understand that access to capital is paramount, particularly for communities I represent. So, and I understand concerns that a change in these requirements could affect the resilience of the banking sector. Though I know you cannot speak to the specifics of the coming proposal, would you share some insights into what problem the proposed rulemaking is meant to solve, and are you concerned that it could lead to a deterioration of resilience of the banking sector?
I'd be glad to. So the idea behind it is that we want risk-based capital to be the binding capital requirement, because we want the binding capital requirement to be, we want banks to be sensitive to the risks that they're taking. If the leverage ratio is not risk sensitive, it treats every asset as equally risky. So if that's binding, then that interferes with banks' incentives to manage their risks and actually discourages banks from taking on relatively low-risk activity. So we've always, at the Fed, wanted the risk-based capital to be the binding one and the leverage ratio to be the backstop. And so that's this proposal that we have that we're going to be meeting on in a couple of hours, puts out for comment a proposal to restore the the backstop characteristics of the leverage ratio. We think it should make it will not in any way diminish the safety and soundness of the financial system, and it will allow for banks to undertake lower risk. Thanks.
Thank you so much. Thank you, Mr. Chair.
Yes, ma'am. Thank you. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Wednesday, July 2nd. Chairman Powell, you have 45 days from that day to submit your responses to the questions for the record. Thank you for being here. This committee is adjourned.
Thank you.